Newlox Gold Ventures, symbol LUX or LUX on the Canadian Security Exchange. The company focuses on niche reprocessing of gold within Latin America. The company does environmentally friendly reprocessing of artisanal tailings, which is effectively the waste of small-sized gold miners, which are normally using less technical ways to extract the gold, so you have more effective gold remaining within their tailings or their waste. The stock currently trades at about 13 cents a share, which is a market capitalization of 19 million. A quick look at the company's current projects. They have 3 ongoing projects, one being operational based in the Costa Rican gold belt. The facility has tailing agreements with over 30 regional mining sites. Before the purchase of any tailings, they conduct in-house analysis. They test the gold concentration, see if it's really worthwhile for them to even take on the gold waste. The company is still investing in the property to build out production, and they're currently ramping up to about 80 tons per day, which is relatively small. The company expects recovery to be about 6,500 ounces per year, and they expect the cost per ounce to be about $600. Next up, the company has the Boston Project, or Project 2, which is a second plant based in Costa Rica. The plant has begun commissioning work, so it's operational, but not really going at full steam. They're just really seeing how it operates, building up their processes and so on. At this time, building up their feedstock from the artisanal miners. And they expect this plant to be able to process up to 150 tons per day at a material grade of about 15 plus or minus 15 grams per ton, which would result in gold recovery of 90%. And the expected full-scale recovery is about 20,000 ounces a year, so about just around 3x per ounces per year, as it's going to have a higher grade recovery and about double the tonnage of their first plant. Last, the company has an early stage project in Antioquia. I know I'm saying it wrong, but it is a province in Colombia where it has completed its due diligence and has agreed to purchase 100% of the project for mineral processing rights within the region from the artisanal miners. The project has a 21-year term, and the company plans to construct a facility that can process upwards of 1,000 tons per day, which is obviously a massive step up because even combining the 2 other projects, you're looking at 4x the processing power just from the one Colombian project. But moving on to the most recent financials, which is fiscal Q2 2024, which ended September 2023, so Q3 calendar 2023. The company does have quite a bit of significant quarterly variance at this time, likely as the operational revenue and costs are really only related to the one plant. And of course, they're building everything else. So you have a lot of one-time costs, R&D, capitalization, which would result in more depreciation during quarters. So you have quite a lot of variance on screen. If you are viewing, there's a 4-quarter summarization, an 8-quarter summarization. But for the last quarter, revenue fell to $663,000 compared to $1.2 million in the prior quarter, or $868,000 in the prior year. Likewise, gross profit also fell to $241,000 from $960,000 and $656,000 in the prior year and quarter, respectively. And net loss was $532,000 compared to $485,000 and $348,000 for the prior year and quarter and year, I should say. So the last quarter, out of all of these last 8 quarters, has been the weakest. Management and in their MD&A, and I couldn't find any additional news releases or press releases. They don't actually give a reason why this was specifically weaker. So this would be a question which we would ask if we were to call them. We'd be asking, why was this quarter weaker? Because notably, their gross profit margin was quite a bit lower. You were looking closer for the last few quarters, about a 70% gross profit margin, versus the last quarter, it was only about 33%. So quite a bit of a difference there, to say the least. So that'd be something we would want to follow up on to figure it out. The company doesn't seem to be great in the press releases or their disclosures in some senses. They actually had a delayed audited financials for their year, and then they seem to push out their fiscal Q1 and fiscal Q2 in short notice as well after the delayed audited financials. So that's something you always do want to be watching out for, is what information they're releasing, because they actually don't release their gold ounces process per quarter. They only have done that on a yearly scale. So you have quite a bit of gap in knowledge during that time period. But moving on as well, some viewers may have noticed during that prior 8-quarter summary, EPS for all but one of the quarters was $0.00 And this is because the company has significantly outstanding shares for the market cap. They have 148 million shares outstanding at the end of the quarter compared to 146 million for the same period last year, which is a small increase for really in the same sense of a junior miner or really building out their capital, same industry, non-junior miner, I should say, kind of like a junior processor, I guess would be how you describe them. So about a 1% increase in shares is actually quite low for a company of that type. But the company has been diluting with options and warrants, which obviously have not been executed at this time. And since they're out of the money, they're not considered dilution for the accounting standards. So the company currently, at the end of the quarter, they had 12.7 million options outstanding, which 1 million would have expired out of money since then. And they had 21 million in warrants outstanding at the end of the quarter, which as well, those warrants have been extended their maturity date, which they were initially all expiring within December of 2023, but they were extended out to 2024 effectively, giving it more time to become in the money warrants. As well, since the end of the quarter, the company has sold additional convertible debentures, which is kind of like a middle point between a preferable share and some sort of fixed income instrument. So it has a 10% interest, as well as it is convertible. And as well, during the same offerings, they were offering warrants at 25 cents. So if you added the warrants plus the convertible debentures, if they were fully converted, fully exercised, you see about another 10.3 million in shares on top of what would be diluted. So overall, you'd have about 192 million shares outstanding if the company were, or if the share price were exceeding 25 cents per share by the end of the year, which would add about 30% more shares to their current count. So obviously, you could see quite a bit of dilution over the next year if the share price actually rises because of all these convertible and warrants and options and all that. As well, the company at the end of their last quarter had a net debt position of 2.35 million. However, that exact value, I will say, has probably changed quite a bit since they're doing all these tranches of debenture raisings as well as warrants. And as well, they're doing capital expenditure. So I wouldn't be surprised if they're actually further into a net debt position as they're investing in these projects. But really, to summarize, the company's current plant in Costa Rica is relatively small compared to its growth plans, specifically the Colombian project. The current Costa Rican project could really be seen more as a pilot project more than anything, as the country really just doesn't have the scale of gold mining operations. The Boston project, which is their project 2, will add some sort of cash flows to the calendar year 2024 as it ramps up production throughout the year. But it's really key to watch how much, what their margins are, and how quick they're able to acquire that feedstock and any other disclosures that they can possibly have. The big test, though, is their expansion in Colombia, and that's really the pivotal point for Newlox. As well, on the risk side, you may need to worry about equity dilution, as well as the interest expense on top of those debentures, as well as the usual commodity risk with literally anything to do with gold. It is lower than a miner, as they are a processor, and it's based on a spread more, but that is obviously still risk. If gold goes down, mining goes down, therefore they'll have less feedstock or worse feedstock. As well, the company has significant execution risk. If the Colombia project fails or falls apart, gets delayed, derailed in some sense, you could see a very big you could see quite a bit more dilution as you have to wait, really stall out the company. They will have to meet other cash flows, as well as if it became more expensive, there's more dilution there. So you really have to watch how they're progressing the Colombian project. So really what I would like to see is hit that point of where internal cash flow is actually funding their growth, unlike now where they're using these external funding methods, mainly equity, bit of fixed income with their debentures. But you'd want to see their operational cash flows flood into their investing capital instead of seeing external financing. So then you're seeing less dilution, which means more return to the shareholder in the long term. So for now, I'd really just wait to see how the Boston project contributes, and as well as the progress on the Colombian project.
Yeah, it's a good summary. I mean, it's interesting what they're trying to do. To get there, you got the share count up to 150 million, and a minimal revenue base really at this point. The expansion could add to that, but over the past 12 quarters, I think they have 2 of operational profit, and it's just very marginal. So to produce an actual earnings per share, like they're going to really have to ramp up revenues, and to do like a cent, you've got to have almost more than a couple cents. You got to have almost more than they have in revenues and earnings right now, and then it's just that's not doable. So we'll continue to monitor the company, but again, when we look at these smaller companies, we do look at share structure, and in this case, there's probably going to have to be a rollback at some point, of shares, and then maybe if they bring those products online or the new projects online, they've had the rollback, the share structure looks better. Perhaps there's some cash in the bank at that point. But I mean, we don't have a direct comparable as a peer, but in the gold processing industry within Latin America, we can buy a company with double the amount of cash in the bank compared to this company's market cap, and a far lower multiple to earnings. There is no PE here because there is no earnings or price to cash flow. It has the same expansion ability. Plus, it can do it without dilution. So those are the companies that we prefer relative to a name like this, even if this company is doing something rather interesting potentially in the market.
If I wanted to make a list of just red flags when it comes to investing that people can look out for when they're deciding on a company or not, having a large number of shares outstanding when you haven't even achieved profitability yet, and then also debt on top of that would be one of those red flags. Now, that doesn't mean that the company won't end up doing okay, but as of right now, I would be concerned. It's something that we would potentially, well, not potentially, we would monitor it. And if things started to improve, who knows? But as of right now, when you're looking at a company that already has almost 200 million shares outstanding, fully diluted, fairly minimal revenue, and no consistent profitability, that's plus net debt, that's a red flag for me.
Yeah. It's how they've built out the business through issuing equity and some debt, and really haven't had the discipline to create profitability. Where there are other businesses out there, maybe not, they don't have the ambition to grow as fast, but they grow more steady. And then when you build up cash, you can actually take a step forward in growth as you get to 10 years into the business, 20 years, 30 years into the business at times, because you've been disciplined. You built up that cash and take advantage of some market condition, some opportunity you have in the market. You can't do it if you build it in this structure, right? There's got to be a lot. I mean, again, this isn't the worst business out there. We can list 600 junior miners that they're not even trying to make a profit. At least this company is endeavoring to make revenues, go out there and do something that, employing people that are actually working and creating cash, creating revenues over time. We'd like to see more cash flow, but we're very stringent in our criteria, and we compare this to the best of the best in its sort of quasi segment, and it's not there yet. So it wouldn't meet our criteria at this stage.
Yeah. And that's where I really mean is when they're bringing in enough internal cash flows, you don't have to rely on the external, your funding.
Yeah.
And that's really what we want to see is the company itself, the operations are making a business. They're not just a capital raising machine, which is just an epidemic for junior miners. And then obviously they are doing that to a degree, but not as fast for junior miners, I should say, as well.
Yeah, and that's why they are public. A public company should be able to access the public markets and raise equity that way, but do it on their terms. If you do it on the market's terms or the brokerage industry terms, or when you're desperate, it just leads to shareholder dilution, and it's just not something that we want for investments that we are recommending to our clients or invested in ourselves.